Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of finance to understand company secrets. Sometimes you just have to look at the numbers to see the whole picture. And today we are diving into a filing from Healthcare Services Group Incorporated that gives us a real look at their financial condition, this company, Healthcare Services. Group Incorporated is a big player in providing services like housekeeping, lawn, and dietary support mainly to nursing homes and hospitals, and their latest quarterly report, the 10. Q gives us a look at how they are doing right up to September 2025. So let's see what is inside this report and what it tells us about the health of the business before we dive deep. Make sure you are subscribed to Corporate Decoder for more content like this, which unpacks financial reports so you don't miss out. And hey, if you like digging into these reports and discussing them with other finance enthus, yes, join our Discord community. It's linked in the description below. This report comes from Healthcare Services Group Incorporated and covers their performance up to the 30th of September of 2025. It shows us their financial statements and what the company is doing behind the scenes. Let us start by looking at their balance sheet. This document shows what the company owns and what it owes at a specific point in time. As of the 30th of September 2025, Healthcare Services Group had about $804 million in total assets. That is a bit more than the $802 million they had at the end of 2024. One of the really important numbers here is accounts receivable, which stands at $288 million. This represents money owed to the company by its customers. And you can see they have set aside over $118 million as an allowance for doubtful accounts, meaning money they might not collect. This allowance amount has significantly increased from the $87 million allowance at the end of 2024, which could signal growing challenges in collecting payments from their clients. Look at the goodwill, which is about $80 million in September 2025. This usually represents the value of a company's brand name and other intangible assets that were acquired in the past. When companies buy other businesses, they often pay more than the net worth of any physical assets, and that extra amount is recorded as goodwill. On the other side of the balance sheet, their current liabilities around $195 million. This includes things they have to pay soon. Something interesting here is the stock information. They have over 76 million shares of common stock issued and about 76 million outstanding as of September 2025. A big chunk of this is tied up as treasury stock, which is stock the company bought back, reducing the number of shares available to the public. Now let us look at how the company makes money and spends it from July to September 2025. They brought in over $464 million in revenue. That is a nice jump from $428 million in the same period last year. And their net income for this 3-month period was over $42 million. That is a huge leap from just over $14 million in the same period of 2024. This is a very good sign for the company's profitability. This means that for everyday shareholders, the earnings per S-share also saw a massive increase from 19 cents to 59 cents. This is definitely something investors will be watching. This next report shows the flow of cash in and out of the company over 9 months ending September 2025. They generated a very healthy nearly $128 million in cash from their operations. That is a massive turnaround from the roughly $5,000 negative cash flow in the same 9-month period of 2024. This street-wrong positive cash flow from operations is crucial for any business. One reason for this big jump in operating cash flow is the significant increase in bad debt provision to over $79 million versus $36 million last year. This seems counterintuitive at first, but it means the company is being more realistic and setting aside more money for debts. It might not collect, which is a sign of prudent financial management, especially considering the note about Genesis Healthcare filing for bankruptcy mentioned later. In their investing activities, they spent over $7 million on an acquisition. This indicates the company is actively looking to grow by buying other businesses. And in financing activities, they spent over $43 million buying back their own stock. This can be a way to return value to shareholders. Going back to the balance sheet for a moment, let us connect this to some of the numbers we see there. Cash and cash equivalents and restricted cash equivalents combined are over $124 million. This is up from about $60 million at the end of 2024, showing they have built up their cash reserves significantly. They also have over $30 million in restricted marketable securities. These are investments that are set aside for specific purposes, like insurance collateral. Now let's look closer at bad debt expense. This is a critical area for any company that extends credit, and Healthcare Services Group is no exception. They have been proactive in recognizing potential losses from customers who struggle to pay. This part is really important. The company notes that Genesis Healthcare filed for bankruptcy in July 2025, at that point Healthcare Services Group had over $50 million in accounts receivable and $20 million in notes receivable from Genesis. They had to set aside a 100% allowance for these amounts, meaning they are not expecting to collect any of that money. This caused a huge spike in their bad debt expense for the quarter. Looking at the income statement again, the increase in net income is quite dramatic. It went from $14 million to over $42 million from the third quarter of 2024 to the third quarter of 2025. This jump really highlights the company's improved performance. Even with the challenges of bad debt, the company also recorded a large amount of income from employee retention credits, or EAC payments, which helped boost their overall revenue and profitability. Their revenues are up both for the 3-month period and the 9-month period ending September 2025. This growth is driven by both their housekeeping and dietary segments, indicating a broad-based improvement in their business operations. While cost of services provided did go up, that increase was largely offset by the ERC refunds, which essentially reduced those costs, meaning their core operations are becoming more efficient as a percentage of revenue. Selling, general and administrative expenses are also on the rise, but this increase is somewhat expected given the efforts to grow the business and the increased professional fees related to the ERC refunds. Their investment and other income also saw a significant boost, particularly due to interest earned on those ERC refunds, and also from gains on their deferred compensation plan. Investments, this shows they are not just managing their core operations well, but also benefiting from smart investments. When we look at their liquidity, meaning their ability to meet short-term obligations, Healthcare Services Group is in a strong position. They have over $177 million in cash equivalents and marketable securities, which is up from about $107 million at the end of 2024. Their current ratio remains healthy, above 29-1 at September 2025, which signifies they have ample liquid assets to cover their short-term debts. The cash flow from operating activities is a standout improvement, as we mentioned, going from negative to positive. This is the lifeblood of any company and shows strong operational performance. In financing activities, they have been actively repurchasing their own stock. This indicates that management believes the company's stock may be undervalued, or they are trying to return value directly to shareholders. The data shows they repurchased nearly 1,744 million shares in the third quarter of 2025 for about $27 million. Overall, Healthcare Services Group Incorporated appears to be on a much stronger footing than in the previous year. Their revenue is growing significantly and their net income has seen a substantial increase. The ERC refunds provided a major boost, but even when you look past those time benefits, the underlying performance of their core housekeeping and dietary services seems to be improving. This is good news for the company and its shareholders. One of the key strengths is their improved cash flow from operations. This is vital for funding future growth, paying down debt, and returning value to shareholders. The significant bad debt provision, though, concerning in isolation, actually signals a more realistic approach to financial reporting, especially given the bankruptcy of a major client like Genesis Healthcare. Acknowledging these losses up front is a sign of good financial discipline. However, there are risks to keep an eye on. The significant increase in bad debt expense due to Genesis is a stark reminder of the concentration risk within the healthcare industry. Thomas, especially those reliant on government reimbursements, can face unexpected financial difficulties. Also, their selling, general and administrative expenses are climbing, which will need to be carefully managed to ensure profitability holds up. In conclusion, Healthcare Services Group is showing strong signs of recovery and growth. The turnaround in net income and cash flow is particularly impressive, and their proactive approach to managing receivables and acknowledging potential losses bodes well for their future stability, while the risks associated with customer concentration and rising expenses are present. The company seems to be navigating these challenges effectively. This report indicates a company in a much healthier financial position than a year ago. Alright, that is our breakdown of Healthcare Services Group Incorporated's latest report. What are your thoughts on these numbers and what they signal for the company's future? Let me know in the comments below if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord community in the description for more discussions. Thanks for watching. See you next time.